Well, good morning, everyone, and welcome to another edition of our masterclasses. And I'm very pleased to say we have today with us Catherine Ramsay from Gannons Solicitors. Catherine, how are you? You well today?
I'm good, thank you. How are you, Mark?
Excellent, excellent. So do you want to give a quick introduction, say who you are, what you do, how you do it?
Absolutely. So hi, everyone. I'm a tax partner at Gannons, and I specialise in particular in employee equity. So that's putting in share plans for companies. Instead of paying your workforce more cash, what we can do is offer equity in the business instead. So that's like you might be a shareholder in your business. It's offering the opportunity for your employees to be a shareholder as well. There are different ways of doing that, which we can discuss this morning, but essentially that's what I do. There's lots of different plans on the market, and it helps people give their workforce more of a stake in the business that they're working in.
Yeah, I can say that's the important point, isn't it? That it's not just going to work and doing your job, but you've actually got a stake in this business. You've got some kind of skin in the game in the business in that sense, isn't it? So perhaps we can just start with having a bit of a glossary of terms, because there's the shares, there's options. Just want to kind of tell us what the difference between the two is.
Sure. So a share is a share, essentially. So you're registered at company's house as holding an actual share in the business, and that share can produce dividends, which is the way that you can get paid out from owning that share. And it also means that when a business comes to be sold, the shares are sold onto a buyer, and you'll hopefully take a nice chunk of the profit with you. The difference with an option is that that's an option over a share. So it's an extra step. So it's giving someone the right to have a share. So it's a bit like dangling a carrot in front of somebody saying, this is what you could have, a share, but you have to go through some extra steps to get it, for it to convert to a share, essentially. And there are reasons why companies might prefer to give their workforce options rather than shares. One of them being that they don't become a shareholder instantly, and there might be something to do first, such as loyalty to the business. You have to stay a certain amount of time, or you have to hit certain profit targets. So it just gives a company a bit more control over the equity they're giving.
Yeah, that's generally how I've seen it work, whereby you have maybe a year, 2 years, 3 years, and then you have the option. And then there's kind of exercising the option and vesting the option. So again, do you want to kind of talk us through
sure.
the differences there, please?
Sure. So exercise is the trigger that the individual actually has to physically do. They have to complete what we call an exercise notice, and that's how the option converts to a share. As to when you are able to exercise that can be vesting. So companies tend to sort of have a vesting schedule. For example, if you have a 4-year period of your option, and you might say, if you're still here after year 1, 25% of your option will vest. So you essentially bank that right to exercise it, but you might have to wait till year 4 to have the exercise. So vesting is banking your right, and that typically happens over a period of service. So if you're still with us after a year, if you're still with us after 2 years, it will vest until it's fully vested, for example, at the end of that 4 years. And that just gives the company control, because they want people to stay in the business. The whole reason that they're offering them the stake is to try, it's a tie-in, essentially, a loyalty program, if you like.
So there's a bit of a time scale, there's a bit of a kind of staging process to it all. You have an option to a share, let's say 3-year option. So after 3 years, you then exercise your right, and then you can vest at that point, soon after. But then obviously you don't necessarily get the money at that point. You'd have to wait for the company to have a liquidity event in some way, shape or form.
Exactly. And that's important for private companies, because obviously if you're a listed company, you can go into the FT, see what your share's worth, and it's quite easy. Whereas with a private company, the liquidity event does tend to be on an investment or on a 100% sale. So they do have to wait, but sometimes there's the ability for a company to create an internal market. So the company could look to maybe buy some back off individuals if they want to sort of exit early. That's not really the mantra behind a share plan, because you want people to stay, but unfortunately sometimes people do have to leave for what we call certain good reasons. We have good leaver, bad leaver. And if somebody's had a car accident or something terrible like that's happened to them, and they can't stay on in the business, you might feel it's a little unfair to make them still wait, or have to give their right up when they've been on that journey with you. So that's really important to think about.
So I guess that's why then, when you see on the telly or on the YouTube, sometimes when there's an IPO or a listing, the champagne corks are popping, that's when you actually get entitled to that money, and you've gone through the vesting and you've gone through the exercise,
Exactly.
and actually get money in your pocket.
And it can actually work quite neatly. For example, if you've often with the option, a price is set for it. So there's no such thing as a free lunch as such. So to exercise that right, you normally have to make a payment. But if that's just done on the sale, then there's quite a neat mechanism where it just comes out of the proceeds of the sale of your underlying shares. The advantage of that being that you don't actually ever have to find the cash. So that's quite useful for individuals if they're worried about the cash that they've got to come up with. But the important thing with options is that generally, if you can get them some sorts of options, then that price is set on day one when the business is smaller, and that's the price you pay in year 4 when hopefully the business is worth a lot more.
Yeah, and that's the beauty of it, really, isn't it? That you've seen that growth in valuation, but you don't have to pay the extra valuation cost to get those shares. And talk to us about tax, because there's always a tax implication. Is there capital gains tax and income tax to play? Or
so on certain type of options, which are called an EMI option, and they're the ones that we typically see smaller SME companies provide, and they're especially for that market, for sort of young, high growth companies with potential. If you set that price I mentioned before at a value that you agree with HMRC, then the whole gain in those shares from year 1 to year 4 should be subject to capital gains tax. Now that's really important, because if you just paid someone's salary, then of course that goes with income tax and national insurance. That can mean that you lose over half your salary that you're being given. Half of it goes to the tax man. Whereas what we're trying to do with a lot of these plans is get people out of the income tax net and into the capital gains tax net. And obviously there is, quite a differential between that. Capital gains tax currently for shares is 20%, but often you can get down to the 10% entrepreneurs relief rates, what formerly known as entrepreneurs relief, now known as business asset disposal relief. So, in a nutshell, hopefully 90% of the value of those shares are going to come back to you on a sale, which is a pretty good deal.
Sure. No, very good deal. Absolutely. Obviously, you had a stake in the business, you get something out of business, you get some money out of the business. Hopefully, it all works really well from an employee point of view. From the company's point of view, why is it a good thing for them to do? Why not just pay cash out? Obviously, we've talked about keeping the employees and keeping them happy, but is there benefits to them?
There's that, obviously, the loyalty tie-in, because cash isn't always king, I like to say. Often if you just pay someone a higher cash salary, they might use that as a benchmark and go to someone else and go, I'm being paid this by my company, can you pay me more? The threat of having to lose what could be a very valuable asset in the future is a good loyalty tie-in for companies. Also, the tax I just mentioned with the income tax and national insurance. Now, of course, there's an employer national insurance element to that, which is quite high. It's 13.8% at the moment. Company would have to pay that on that exercise on a sale. So it's not just the individual having to come up with that tax. And again, with these plans, if we're trying to get it into capital gains tax rate net, then obviously they don't have to pay that employer national insurance. If you've got quite a lot of people that you're in your workforce that you're paying, that can be quite a significant saving.
Yeah, and I'm guessing from a cash flow point of view, it can be some savings there because you're not paying out so much salary. You're paying obviously in shares instead.
Yeah, you're deferring that element of their pay packets. So if somebody's coming to you, especially in the market today with the pandemic, with Brexit, cash is tight for everybody. If you're trying to keep, and it's not actually just about keeping the people, but it's also about recruiting. It's a very good recruitment tool as well. If you've got somebody that you're really keen on, a key player that you want to come and work for you, and you can't manage their asking price as such, you could say, well, actually, I can pay you this much, but I can give you the rest in shares that ultimately should be worth a lot more than what they were asking for up front in cash. So it's good all round.
Fingers crossed, obviously. I guess it could go one or two ways, I guess, can't it, with the company?
One of two ways, and that's important to say. There's a speculative element to shares. It's a risk. It's a gamble in some respects, but that's what it is to be a shareholder in a business, and that's hopefully it's what it could materialize into. But I don't think that cash will ever be completely null and void in terms of what people are looking for. So we do often see that people still want a cash bonus sometimes alongside that. obviously tying all your money up into something that might not materialize until an exit. People have to live, and sometimes giving that cash bonus element alongside it will help. So we tend to see quite a differentiated remuneration packet that people are looking for.
Yep.
So they'll want their salary elements. They might often want that sort of annual cash bonus, and then we typically see maybe a third of it deferred to later. But
yeah,
yeah,
I guess it's still important to have the cash from a mortgage point of view, because obviously you need that to justify your mortgage.
Yeah, you do, and you need to live as well. And so it's all very well saying I could have all this payout in 4 years' time, but that is in 4 years' time. So it's a balancing act, and it's different, Mark, for different employees. It's quite a psychological thing. You really need to think about what's going to motivate somebody, and it's different for different people. Because of course it's only going to work if they are incentivized by it. So we often see clients who put a lot of effort into putting these plans together, but if it's not communicated properly to people so they understand what they're getting, then it's not going to work.
Yep. And I think you mentioned bad leavers earlier, but we didn't mention good leavers. So if you just if you want to change your job, but you're only, let's say you've got a 3-year share option, but you're only a year and a half through, what happens in that scenario?
So often you might be able to keep your options if you leave for good reasons. There is one big caveat to that. If you have an EMI option, which is that particularly tax efficient one I mentioned, then you do have to be an employee still to get those benefits. What the Revenue have done is they allow a 90-day period after leaving to exercise to keep those rights. So it's different for different clients. Some people just say, if you leave my business for any reason, your option lapses. Or if you have shares, you have to give them back. But it really is dependent. So typically what's market is we see the good leavers are typically ill health, disability, redundancy, retirement. And then we normally say a bad leaver is anything else, and unless the board decides otherwise. And that's important, because if we straitjacket it too much, people don't have a crystal ball, and there are certain scenarios in the future where it might be like, well, actually, maybe we'd have thought they're a bad leaver, but we want to change our minds. So it gives that flexibility. But the main two bad leaver ones typically would be, gross misconduct, being fired essentially, and going to a competitor.
Okay.
Because people are being given this incentive to stay in your business, and you don't really want someone going off to your competitor with shares in your business. That's not how it's supposed to work.
See what you mean? Yeah, makes sense, absolutely. And you mentioned 4 letters earlier that always strike the fear of God into me, HMRC.
Yeah.
So from a business's point of view, there's quite a few kind of hurdles to jump over and eligibility issues to get things going.
So for any optional share, you do need to start thinking first of all about what's it worth. Because HMRC's starting point is that if you give somebody a share or an option in your business and they're employed by you, that's another way of paying them salary. It used to be that they didn't look at it like that, but they've got quite savvy to this. So we have to try and get out of that and go into the capital gains tax regime. And the way that HMRC have agreed this, especially for EMI, for example, is if you agree a value with them, then they'll rubber stamp that, and you don't have to worry about any tax nasties coming along. Okay. How do you value that? Well, private company shares, obviously, it's not as simple as just looking at what the listed share price is, because there isn't one. So typically, HMRC will look at what your commercial value is, and then we discount down from that for certain things. So we typically say, well, a share or an option in the hands of an employee isn't worth the same as an outside investor. Why? Well, they are generally, as we've just said, forfeitable on certain events like leaving employment. If they're linked to an exit, well, that exit might not happen. And if that exit doesn't happen, then their option doesn't materialize, for example. Yeah. So that remoteness. So there are various things that mean that the value agreed is a lot lower, because that's one of the main things that clients come to us and they say, well, we've had an investment of X amount and that came out at, £100 a share. Is that what people are going to have to pay? And I'll say, well, no, because there are discounts, because it's not the same as in the hands of an investor. So, but HMRC are, they are trying, especially with EMI, they're really trying to give a really good benefit. But as you say, there are strict qualification criteria. So the main ones for EMI would be you have to have less than 250 employees, for example. certain trades that don't qualify. Businesses in the financial and insurance sectors, for example, tend not to qualify, but there is something called an advanced clearance process, which you can apply to HMRC if it's a grey area. And we've had quite a lot of success with that, because HMRC are quite woolly on some of these points of what they think qualifies. So there's always scope for negotiation. And at the moment, there's an EMI consultation out with the government, and they are looking to extend it. So they are really trying to give businesses this benefit, because EMI is actually the most tax efficient plan that any country offers in the world. So it really is a good thing, and that's normally our starting point for businesses. Do you qualify for EMI? If not, we'll have some thoughts about what else we can do.
Yeah, I'm going to say, because we were talking earlier, but EMI and EIS are very based on pretty much the same rules and eligibility criteria. So you generally, if you qualify for one, you qualify for the other, don't you, if I remember correctly? I know with EIS, obviously, there's a lot of traps and a lot of things to be aware of. Do you want to give us kind of an idea of what to be aware of with EMI as well?
Yeah. Well, actually, one of them is very much to do with EIS. And if there's EIS or SEIS in a business, then we do have to be careful. And that's because, as I'm sure you know, Mark, EIS and SEIS shares can't be seen to have preferential rights. When we put in an EMI plan, for example, the example I gave just now about being forfeitable, that can be seen to give other shares a preference because they aren't forfeitable. So it's not that you can't do it, but that's where we come in to make sure that companies can safely not prejudice their EIS investors. And that does have to be looked at carefully. Another trap would be, well, that you might disqualify yourself. So as you grow, the limits I've just mentioned, 250 employees, for example, that's on a group basis. So for example, if you start off with just one company, but you get bigger and you open some other subsidiaries, it can be quite easy maybe to forget that the 250 is on a group basis. So you have to look at your company as a whole. If you fall out of it, the options you've already granted are still protected with that tax regime, and that's important.
Okay. Oh, so they're ring fenced, are they?
They're ring fenced, yeah. You're okay. It just means that any further options you grant won't have that tax wrapper around it. So that's one of the main things. And then the other thing to think about is dilution. Obviously, if you are giving people shares or options, that can potentially dilute the existing shareholders. So you do need to have that discussion in the company if you're not just the 100% shareholder about what people are happy with. Now, options, until they convert to the share, don't technically dilute. So that's one advantage of an option. If you just have it and it's exercisable on an exit, then you're still retaining control of your business, because these people under option will only be a shareholder for a split second. So sometimes that's why people prefer the exit only option, which is how we phrase it in the business, because you're still retaining that control up until exit.
Okay, so there are some pitfalls to be aware of. As always, good to use a good solicitor or a lawyer or a tax advisor. So I'm sure you know someone who could probably do that. My last question, just before we finish up, was around, obviously, talk about EMI schemes. I know growth shares are becoming very popular these days. Do you want to talk us through growth shares as well, please?
Absolutely. So growth shares are really popular because, as I said, EMI still requires some qualifications. And one of those is that you have to be an employee or an employee director. Now, there are companies that might want to give, for example, their chairman or another non-executive an award, and they still want to make that tax efficient. Growth shares are a way of still mimicking, to a large extent, the tax advantages of EMI, but you do it through actual shares. So there's an upfront share reward, but what you say is this share has restrictions on it. There's no voting, there's no dividends, nothing can happen with that share until the cap's taken off it, basically, and that could be on an exit as well. Now, the advantages of that, as I said, the qualification. Also, growth shares can often come in at a much lower value because we create a brand new class of shares in the business. Again, there's something to watch out with that is if you have investors, you want to check that they're happy with a new class of shares being added. But essentially, the main difference is growth shares just capture future growth in a business because they're being created on now, a point in time now, and they'll just capture the growth from now until, say, an exit. Whereas an option will cover the current value and the future value. So one of the reasons why people like growth shares is that it does ring fence the existing shareholders, and it keeps the existing capital for the existing shareholders. So it's only the future growth. So they are becoming more and more popular. especially if the price of an EMI valuation comes out quite high, because if you're at a slightly later stage in your growth cycle, even with the discounts I mentioned, HMRC will still put a value on that share. If that's seen as too high, then the growth share, which just captures that future value, can be handy.
Sure. So you're just capturing the growth, and that's the name, I guess. Yeah.
And also the psychological part of all this that I mentioned earlier. For some people, they still just want shares. It's a psychological thing. Even though it's a share with a lot of restrictions, they like having their piece of paper, their share certificate, to say, I'm a shareholder.
Yeah.
So it comes back to what's going to motivate someone.
Okay, like having that physical piece of paper in their hands. And if I remember correctly, growth share can be EIS qualifying as well, can't it?
It can. Again, you need to be very careful with the preferential rights that I mentioned before, to make sure that you're not causing any problems for your EIS or SEIS. But that's where we'd say come and talk to us, because there are things that can be done to make sure it's structured in the right way.
And that feels like it's a good place to end things, because if you have any thoughts or advice or need anything more, then yeah, go and speak to Catherine at Gannons, get a bit more advice. Where can people find you or get hold of you, Catherine, if they need to?
Well, you can visit our website, gannons.co.uk, and my email is Catherine@Ramsay, RAMSAY @gannons.co.uk. You can also find me on LinkedIn.
Brilliant. Okay, thank you very much for that whirlwind tour through EMI and Growth Cert. That's very kind of you, Catherine. Thanks a lot. We'll see you again for another masterclass when we do our next one. Thank you very much. Take care. Bye.
Bye.